High dividend yield looks like free money, but sometimes it's a warning sign. In this video, you'll learn what a dividend trap is, why high dividend stocks can underperform, and a simple checklist you can use to avoid the worst mistakes. First, we need one quick definition. Dividend yield is the dividend divided by the stock price. Yield equals dividend divided by price. So if a company pays $1 per year and the stock costs $25, the yield is 4%. Here's the catch. That yield can go up even if the dividend doesn't change. If the stock price falls, the yield rises. So a suddenly high yield can mean the market is pricing in trouble. That's why the headline yield can be misleading. Sometimes yield is high because the business is strong and generous, but sometimes yield is high because the price dropped for a reason. Now let's talk about the double whammy. When a company is under stress, the dividend can be cut, and dividend cuts are often followed by price declines, so investors can get hit twice. Income goes down, and the value of the shares goes down. A well-known example is Walgreens. At one point, the yield looked extremely attractive because the share price fell, but later the dividend was cut and the stock price continued to struggle. The lesson is simple. A big yield can be a warning label, not a bargain tag. Next, the most important mindset shift. Don't judge an investment by dividend yield alone. What matters is total return. Total return is the change in price plus the dividends you receive. Dividends are not extra money that appears from nowhere. They're one part of the return, and the price can move the other way. So how do you spot a dividend trap before it hits you? Here are 3 red flags. Red flag number 1, a very high yield. Ask the obvious question, why is it so high? Often it's high because the price dropped fast, and that drop can signal that the dividend is at risk. Red flag number 2, the payout ratio. In simple terms, that's how much of earnings the company pays out as dividends. If the dividend looks larger than what the business can reasonably support, that's danger. A dividend can't be safe if it's being funded by shrinking profits. Red flag number 3, cash flow cover. Earnings are accounting. Cash flow is reality. A healthy dividend usually needs steady, predictable cash flow. If free cash flow is negative or the balance sheet is getting stressed, the dividend becomes vulnerable. Now, what should you look for instead of just yield? Look beyond yield. 3 ideas help. Dividend growth, companies that can raise dividends over time. Shareholder yield, dividends plus buybacks, a broader picture of cash returned. And quality, strong finances, durable business models, and the ability to survive bad years. Let's wrap this into a simple anti-trap checklist. 1. Why is the yield high? 2. Is the payout ratio sane? 3. Does cash flow cover the dividend? 4. Is the business quality stable? Dividends can be great, but chasing the highest yield is how investors get entrapped. Focus on total return and focus on durability. Comment below, do you care more about yield or total return? And as always, this is not financial advice.